Hello everyone. I'm pleased to welcome you to this webcast on amendments to Section 7, Statement of Cashflows of the third edition of the IFRS for SMEs Accounting Standard. You will recall the third edition of the standard was issued in February 2025 and is effective from 1 January 2027. In this webcast, we will cover new disclosure requirements included in the updated Section 7 on changes in liabilities arising from financing activities and supplier finance arrangements. Together with the new disclosure requirements in Section 11, Financial Instruments, related to analysis of the age of trade receivables and other financial assets, and maturity analysis of financial liabilities, these disclosure requirements respond to feedback that users of SMEs financial statements need better information about an SME's cash flows and liquidity. Let's first talk about the disclosure on changes in liabilities arising from financing activities. Paragraph 7.19a states that an SME shall disclose a reconciliation between the opening and closing balances in the Statement of Financial Position for liabilities arising from financing activities. Liabilities from financing activities are liabilities whose cash flows were or future cash flows will be classified in the Statement of Cash Flows under financing activities. On the other hand, financing activities are defined in the standard as those activities that result in changes in the size and composition of the contributed equity and borrowings of an entity. This new disclosure requirement enhances information for users of an SME's financial statements about the SME's debt, including the debt's non-cash changes. The reconciliation will help users estimate an SME's future cash flows required to settle financing activities. So what items should be disclosed in this reconciliation? Section 7 identifies 5 items. First, changes or movements related to financing cash flows. That is, cash inflows from new borrowings or cash outflows to repay existing debt or interest. Second, changes because the SME obtained or lost control of a subsidiary. If a new subsidiary has a liability arising from financing activities, it must be disclosed in the reconciliation as non-cash changes. Third, changes because a liability is translated from one currency to another, which happens if the liability is denominated in a currency that is different from the presentation currency used in the SME's financial statements. Fourth, changes because of measuring at fair values. For example, changes that occur if a liability from financing activities is within the scope of Part 2 of Section 11 and is measured at each reporting date at fair value. And fifth, all other changes. An example could be cost related to origination of a financial liability. So this is an example of a disclosure of a reconciliation of changes in liabilities arising from financing activities. As you can see, it shows the liabilities presented in the top row with a column for each of them. The movements from their opening balances to closing balances. The movements are disaggregated to comply with Section 7. For example, non-cash changes for new finance leases. Again, this is just an example to illustrate how an SME could comply with a disclosure requirement. Depending on an SME's specific facts and circumstances, a different format and disaggregation of reconciling items could be more appropriate. In complying with the requirement to disclose the reconciliation of changes in liabilities arising from financing activities, some SMEs could extend the disclosure to a net debt reconciliation, particularly in jurisdictions where a net debt reconciliation is commonly disclosed. A net debt reconciliation is a reconciliation of movements in financing activities minus cash and cash equivalents. A net debt reconciliation provides users of an SME's financial statements with an understanding of the SME's solvency, including the resources it has available to settle its financing liabilities. Now on to supplier finance arrangements. First, let me briefly talk about what a supplier finance arrangement is. Supplier finance arrangements help companies with their cash flows. Often, a bank will pay suppliers on behalf of the company. This arrangement can give companies extended payment terms, or the company suppliers receive payments earlier than the related invoices payment due date. Supplier finance arrangements are often referred to as supplier chain finance, payable finance, or reverse factoring arrangements. This diagram illustrates a supplier finance arrangement. The SME, as the buyer, purchases and receives goods or services from a supplier on agreed payment terms. A finance provider offers to pay the amounts the SME owes to its supplier. Then the SME agrees to pay the finance provider on the same date as, or a date later than, the supplier is paid. So what is not a supplier finance arrangement? Arrangements that are solely credit enhancements for an SME are not supplier finance arrangements. For example, financial guarantees and letters of credits used as guarantees. Instruments used to settle directly with the supplier the amounts owed are not supplier finance arrangements. For example, a credit card an SME maintains with a bank. So before we talk about the disclosure requirements, I would like to highlight that the IASB did not introduce recognition, measurement, or presentation requirements specific to supplier finance arrangements. SMEs must develop their own accounting policies on how to recognize, measure, and present these arrangements. Now let's talk about the disclosure requirements for supplier finance arrangements. The information provided by these requirements should enable users to understand the effects of supplier finance arrangements on an SME's short-term cash flows and liabilities, and exposure to liquidity risk, and how the SME might be affected if the arrangements were no longer available to it. Broadly speaking, these new disclosure requirements have 4 aspects. An SME shall disclose in aggregate, first, the key terms and conditions of supplier finance arrangements. This information should provide context regarding the arrangements when they are used and their terms. Second, quantitative information about payables that are part of supplier finance arrangements. This includes reconciling these amounts to the statement of financial position. The SME should also disclose separately any payables for which the supplier has already taken payment from the finance provider, unless it is impracticable to do so. If it is impracticable, the SME must state that fact. Third, the range of payment due dates for both the financial liabilities that are part of a supplier finance arrangements and other comparable trade payables that are not part of such an arrangement. If the range of payment due dates is wide, the SME would also need to explain why this is the case. Fourth, non-cash changes. An SME must disclose the type and effect of non-cash changes in the carrying amounts of the financial liabilities that are part of a supplier finance arrangement. In this illustration, the disclosure starts with the key terms and conditions, introducing the types of arrangements the SME has. The carrying amounts of liabilities and their location in the statement of financial position are clearly disclosed, including the amounts for which suppliers have already received payments. The disclosure also provides the range of payment due dates for liabilities that are part of a supplier finance arrangement and for those that are not part of such an arrangement, allowing for a clear comparison. Again, if the range of payment due dates is wide, an SME must provide an explanation. Determining what constitutes a wide range is a matter of judgment. Lastly, non-cash changes are also explained. In this example, the non-cash changes resulted from the derecognition of trade payables and the corresponding recognition of finance payables. Now that we've reviewed the new disclosure requirements in Section 7, let's look at what other resources are available to support an SME's transition to the 3rd edition of the standard. The IASB has published a project summary and feedback statement and an effects analysis alongside the 3rd edition of the standard, as well as a markup version of the 3rd edition of the standard showing the changes made since the 2nd edition. The IASB technical staff is also updating the educational modules, prioritizing the sections with significant changes. These modules provide support to anyone learning about or applying the standard. The updated version of Module 7, covering Section 7, is now available. The IFRS Foundation also publishes quarterly newsletters and a podcast series dedicated to the standard. The newsletter summarizes news, events, and other information related to the standard. The podcast offers bite-sized insights to support implementation. And finally, you can submit implementation questions about the standard at any time. You will find the link to submit questions on the supporting implementation page on the IFRS Foundation's website. And with that, we have reached the end of this webcast. Until the next webcast, thank you very much for listening and watching.